Good morning, everyone, and welcome to BlackPoint Capital Partners monthly market recap for month of March 2026. Joined by myself, Nico Mauricio here, partner at BlackPoint Capital Partners, along with Chief Investment Strategist Arun Kaul. Before we get started today, just a quick disclosure, this presentation is for informational purposes only and does not constitute any investment advice or a recommendation for any specific product or strategy. All examples are hypothetical and for illustration purposes only. Here's what we're covering today. 4 topics that are at the front and center of the market right now. Number 1 and the first one is the economic backdrop, some GDP slowdown and geopolitical risks. Second, the Fed and inflation pressures. Third, credit and equity markets, tight spreads and ongoing rotation. And fourth, real assets with the gold and dollar and commodities wrapping up the conversation today. With that being said, over to you, Arun.
Great. Thank you, Nico. So just to touch on the growth GDP for the U.S., we had Q1 come in at, or rather Q4 come in at 1.4%, which was down significantly from the 4.4% in Q3, largely because of the government shutdown, which reduced federal spending, and that was the October-November period. We certainly had some consumer spending deceleration, and we had a little bit of a slowdown in exports, and it was not offset by private investment, which remained strong, in particular CapEx with data centers and with AI. And of course, more recently into this quarter, the forecast is for 2% or maybe just above 2% for Q1. And the most recent event was the Supreme Court ruling against the Trump tariffs, which they'd use the IEEPA guidelines to follow. And what the administration did was immediately remove the old tariffs, which the Supreme Court said were not legal, and put new tariffs on under a different ruling under Section 122. So effectively, the tariff regime hasn't changed, although we have a lot of uncertainty now as to whether or not refunds will be sent back to consumers from the prior set of tariffs.
Thank you for that, Arun. And just a couple of questions. Obviously, you just mentioned tariffs, but one of the other big shocks that we got last week was the jobs report.
Right.
Can you tell us, how do we interpret that data? There was a pretty decent sell-off in the markets last week. What does that mean for us moving forward if we're looking at interest rates and the economy as a whole?
Yeah, so it's an important question because the jobs data has been incredibly mixed. Tremendous number of revisions and a lot of changes month to month based on some of the gaps we have in reporting. So the best way to think about this is we've effectively removed about 300,000 government workers from the workforce over the last year, and we've removed a significant number of migrants, whether they were here illegally or they chose to self-deport. So those numbers have come out of the workforce. The number of American-born or citizen workers has actually gone up. So there's a pretty big adjustment happening under the scenes. So the actual job data has a lot of noise in it. The interpretation isn't simple and it's not straightforward. But on balance, what the administration is doing in terms of many of the executive orders, which favor economic activity in the US, whether it's drilling or materials or becoming a crypto center or having semiconductors built here in the US, they're all largely pro-growth, but they are being offset by some of their other policies, namely removing many immigrants from the country that are here legally or do not have legal status. So you're seeing a little bit of an ebb and flow where some of the benefits are longer term and some of the negatives are a bit shorter term. And that's what you're definitely seeing in the jobs report.
Great. And so it sounds like a bit of a transition period, right? We have the jobs report coming out, but we're also transitioning to more American, born jobs, things of that nature. So thank you very much for that. What I'd like to talk about now and just really kind of understand, well, what about the Middle East conflict? We've had some pretty serious changes in the markets where geopolitically over the past couple of weeks. Can you tell us, how do we start to interpret that data, and what's actually happened since the 28th of February?
So I guess the most significant for the markets has been the price of oil. which has reached as high as $100 for West Texas. It's a very substantial increase from where we were. It's a good 45% increase. And we're seeing, as we're seeing today, we were up as much as 20%, and now the market was up around 9 or 10. So some pretty dramatic moves that will flow through to cost basis in the economy. And of course, we've seen the Strait of Hormuz potentially close, or for the moment, not seeing a lot of vessel traffic. So that will definitely cause issues in terms of the flow of energy for many markets, maybe less so for the US, but certainly for other markets, the Far East and Asia, that are more reliant on the Strait of Hormuz for the importation of oil, China in particular, but certainly India and Japan are in that as well.
Great. And so you mentioned it there. I think everybody's asking about energy. We see the price of oil, as you mentioned, going above $100 per barrel. How does that impact inflation moving forward into the rest of the year? Do we have to make any changes? Do we see the Fed potentially making any changes around that? When it comes to energy, really.
So right now, for the Fed, yes, the Fed will definitely have a concern about potential inflation, although they will, if it's short term, look through it. So they won't be concerned about a very short term event. Right now, we're at day 10 of the conflict. So if it is resolved in the short term, or let's call that 4 weeks, which was the initial framework or timeline from the administration, if it is such that the fighting ends within 4 or 5 weeks and the price of energy returns to normal and the Strait of Hormuz is effectively reopened, then the Federal Reserve would probably look past that. The difficulty is if the timeline gets extended, and if the uncertainty gets extended, then the impact for inflation becomes more longer term or permanent or less transitory, which was the Fed's favorite word 4 or 5 years ago.
Yeah.
So right now, I think it's still a little bit too early to say exactly what the long-term impact will be, because it really depends on what the duration of the conflict is.
Got it. And so obviously, as you mentioned there, short term, I think we look past a lot of these events. Just one last question. If it does go past that 4-week time frame, taking inflation out of the conversation, from a portfolio side of things, are there certain things that we should be looking at this point in time, or is this maybe a sit tight and hold position as we move forward into the day 11, if you will?
Right. Well, we're definitely seeing certain areas get support or bid up further. Defense stocks is one area. Energy stocks have a much stronger bid behind them as well if the price of energy is higher. The AI and the software story is completely separate from what's happening in the Middle East, so that story doesn't change. You definitely see some pressure on the consumer, so consumer discretionary items would come under more pressure, and the market may favor defensives like consumer staples or utilities. Some of that was already happening before the conflict began, so you've seen some strong run-ups in some of those prices. So it's very, very volatile backdrop because a lot of the moves have already occurred in the market. And again, if we see some unexpected progress or faster than we think resolution, you might see a lot of some of these trades unwind fairly quickly as well. So I think focusing on inflation expectations is a good short-term metric. It's ticked up just moderately on the 5-year forward expectations from 2.4 to 2.5. We really don't want to see that run a lot further in the near term, but I would say that's probably one of the better gauges to look at in terms of the longer term impact.
Okay, perfect. And so just on to that, then let's talk a little bit on the Federal Reserve and some of those inflation numbers. Can you talk about what we've seen so far for January CPI and some of the outlook that we have for the rest of the year here?
Yeah, so inflation is remaining sticky. I would mention, I think the Federal Reserve is into year 6 of missing their target for inflation, which is 2%. So they are, given that they're so far offside on their own mandate, they're being extra cautious or more risk averse to keep rates higher to ensure that inflation is actually going to come back down. And now, of course, we have rising energy prices potentially and falling jobs, which is the worst case scenario for the Federal Reserve. That gets us into a stagflationary potential environment.
Yep.
which they'd be very concerned about. So there is some probability that that scenario increases in terms of a stagflationary environment if the conflict goes on for longer than anticipated.
And so with that being said, then I guess the biggest question, you sort of answered it there, Arun, but just to directly answer, ask the question, we're currently at, let's just call it a 50% chance of having at least one cut this year. If these inflationary increases, energy starts to increase, and we still have this geopolitical risk outside of the States, do we still anticipate a cut this year, or do we maybe push off until 2027 at this point?
So I think for now, we're still expecting 1 or 2 cuts this year. And also, we are going to have a new Fed chairman.
Yep.
That's supposed to happen in May of 2020 of this year. So we've got uncertainty within the Fed as well in terms of the chair position and how some of the individual members will vote. So I think there's uncertainty at that level, again, before the conflict began, which was February 28th. So we have kind of a second level of uncertainty with the Fed, given the chairman, the change at the chairman level.
Great. Thank you very much for that, Arun. And I guess on to now credit markets. Let's talk about that. Are they priced for perfection? As well as some of the bigger concerns that we've seen across the board in the credit market. Talk to us about that, Arun.
So in the public markets, investment grade bonds, the spreads are very tight. They're near historic lows. So corporate bonds, investment grade, A and B rated bonds are trading as if we are in a no landing scenario, meaning that the economy will be fine. High yield bonds are also trading very close to lows in terms of their spreads. They ticked up a little bit recently, but they're not very high relative to stress periods. So we're not in a stress period at the moment for high yield. So public markets, yes. Private markets have also traded at lower levels of spreads and are tighter than they've been historically.
Mm-hmm.
However, we're seeing some signs of stress emerging where some of the funds, private credit funds, some of the larger firms, the BlackRock, Blackstone, Apollo, Blue Owl, have started to limit the ability of redemptions on some of their funds. Now, in the case of Blue Owl and Blackstone, they made exceptions and actually reimbursed above what they were required to do and met the liquidity parameters. In the case of Apollo, they were quite vocal, saying they think there's going to be more stress. Blackstone's at the end of the other end of the spectrum, saying a lot of this is noise. So we're definitely seeing signs of stress emerge in private credit, but for now, it's at the liquidity stage, i.e., some of the funds that had limited or restricted liquidity are feeling some pressure to offer potentially higher liquidity or not to do so. At the default level, which is the real issue, are we going to see an increase in defaults? We're not seeing that right now. The most recent data from Q4 of last year show defaults are extremely low and pretty much close to their averages for the long term. Mm-hmm. So we're not seeing stress at the default level, okay, right now, but we're seeing pricing stress in public BDCs, and we're seeing liquidity stress in some of the restricted vehicles, restricted liquidity vehicles, or some of the private BDC vehicles.
Okay, and so sounds like a lot on the private credit side. Let's actually take a shift over, Arun, because I believe you covered a good majority of some of the concerns there, to the public markets outside of credit. We did see equity rotation. U.S. has continued its losing streak against international markets. Talk to us about what that means going into 2026 for the S&P 500, for instance, versus the rest of the world.
So we're definitely seeing a rotation away from U.S. stocks, where the U.S. has won for a very long, it's a 15-year period of time. This is the longest period of underperformance for the U.S. since 2009, driven in part by spreads and valuation and by an increase in commodity prices, where in some foreign markets have higher commodity exposure than U.S. markets have. So that's certainly been part of it. And we're also seeing a shift within the U.S. market from growth names, which has dominated also since 2010, from growth towards value. So those two are happening in tandem, where we see value being more competitive with growth and international more competitive with the U.S. So they're related because the S&P 500 has a much, much higher weight to growth names. The Mag 7 are all growth names. So as they and technology underperform, then value and international names tend to do better.
Okay. And the biggest thing, right? So one of the glaring numbers I see here on the screen, US at a 22 times PE versus EFA at 13 times PE. At what point do we make that shift towards EFA moving forward, just given the such a huge disparity between the multiples at this point in time?
Yeah, it's an important question because for this outperformance for the emerging markets or the international markets to persist, you need to see continued higher growth and margin catch up from the other international names. And
Hmm.
I'm not sure that we see that for a prolonged period of time unless you really see a stronger run in commodities. That the US has been so significant on the outperformance has been because the growth has been higher and the operating margins have been much higher. The spread right now is 20% operating margins for the US market versus 12 for EFI.
Yeah.
I think US for 20 is for some of the growth names, but you're seeing much, much higher margins in the US than you are in international names. So we really need to see some of that compress. And I'm not sure that we see that compress for a prolonged period of time.
Understood. So again, I think one of the other things that you just mentioned there, outside of the equity markets, is commodities.
Mhm.
Gold has continued to shine. It's the darling, if you will, of a lot of portfolios right now. Dollar seems to be stabilizing, whereas it was weakening for a while there. Talk to us a little bit about some of those real assets and how we should interpret this moving into the rest of the year.
So definitely gold is benefiting from a move, well, instability, so geopolitical instability. So that's a significant support for gold. There's also been a large move by foreign countries to reduce exposure to the US dollar post the US freezing Russian assets at the Russian-Ukraine war. So foreign central banks are attempting or raising their exposure to gold as part of their reserve policy management. So that's been a beneficiary. And then, of course, there's been a decline in the US dollar. So gold has been an offset to some of that. So you've got several reasons for gold to do well. I think they're longer term in nature, where a lot of countries try and reposition away from the US dollar, or foreign central banks try and have higher reserves not tied to the US dollar.
Yeah. And so with that, then obviously gold is a meaningful position in some portfolios, up to 5% allocation. Do we continue to add to that? Just given the fact that we're close to all-time highs at this point in time, there's the geopolitical backdrop that we're seeing at this point in time. What's the argument for increasing that position, or do we stay where we're at this point in time? What's the thought process there, Arun?
Yeah, I think it really, 5% allocation to gold is pretty high by historic measures. Certainly 10% would be well above an average allocation for a typical client. So I really think it depends on the overall risk profile. More
Hmm.
aggressive accounts might be comfortable adding to the exposure, and I think more conservative accounts might be more comfortable just holding where they are. But a 5 to 10% exposure to precious metals is definitely at the high end of where historic allocations have been, even during past periods of time where gold has done well.
Okay, perfect. Well, thank you very much for that, Arun. Well, just wrapping up, so a few key takeaways for today. One, we are seeing U.S. growth slowing significantly. Q4 at 1.4, whereas Q1 forecast is 2.1%. The Iran conflict does continue to escalate some of those geopolitical risks, supporting some gold and energy sectors as well. The Fed is kind of caught between a bit of a rock and a hard place with weak jobs, rising inflation pressures, as well as some of the geopolitical risks as well. Um, Credit markets as well. They do seem to be priced for perfection at this point in time with tighter spreads, assuming no landing. And the last part here is the 15-year US equity dominance does seem to be potentially coming into an end, where a rotation to international, as we've done across client portfolios, is starting to really outperform. And that's really what we want to see moving forward. But that's it for today's conversation, everybody. Thank you very much for that. Thank you very much for Arun for spending some time today to just talk about what's going on in the markets. If there's any questions, if anybody has anything that they'd like to reach out to us on, please reach out to info@blackpointcp.com or to your individual advisors. Thank you very much today and have a great day.